Hi, Dan Kautz here.
Good morning, Jeff Buckley.
And here we are in July 2026, and it's time for our webinar for July. And again, you guys all know by now, you've been watching this so many times, that Jeff takes a lot of time and effort to put these together. And again, Jeff, thanks for doing that.
Sure, of course.
And
Yes.
we're going to move right on to the slide that's mine, my big responsibility here. This is our disclosures, right? So we can't receive any texts or calls while we're recording this. And our contact information is dkautz@kautzbuckley.com and jbuckley@kautzbuckley.com. Our office text number is 716-272-1129. Very popular. A lot of people use that, and we have a lot of success with that. But you can always just call us at 716-276-8480. And what I also want to do is make sure everybody out there knows and is invited to our Midsummer Economic Review and Market Update. That happens on July 22nd. If you're interested in attending, just come on by. We're going to have a gentleman from Clark Capital come on by and talk about how things have gone so far and what we expect to see in the upcoming 6 months.
Right.
So if you'd like to join us, please call or text us at this number and we'll get you on the list. It's July 22nd. That's a Wednesday. And I think we start around 5:30. We will have a little buffet dinner being served.
Right.
And come on by, bring a friend. All right. So Jeff, let's get into your hard work. Let's start where we usually start. How are we looking this month?
Well, it's interesting too because we're just finished out June, so we do get the opportunity to kind of look back over the first half of the year, and then we're going to kind of try and project out what we may see over the next 6 months here, depending on what's happened so far. June was an interesting month. June itself, we had quite a bit of kind of really the breadth that we've been talking about a lot on these webinars, where we started to see, I mean, I guess if you look at the top and the bottom of that first column there, kind of shows you the micro cap and really the top couple sections there, Russell 2000, as compared to the Magnificent Seven at the bottom. What that kind of tells everybody there is a lot of money kind of pulled out of those tech high flyers, the NVIDIA, the chip maker, Apple, Microsoft, et cetera, and really went out into other companies that are much smaller in scale, use a lot of regional companies, not as diverse of companies, but they represent really the breadth in our overall market. So it was a kind of a refreshing thing to see. And if you look, we kind of, because of what happened in June and also really the entire second quarter of the year, we've been experiencing that, because if you look over at the column for the second quarter, Russell MicroCap was up 26.1% versus the Magnificent Seven only up about 11%. And most of that had come, it came kind of as the war started. People, I think, became somewhat nervous and kind of went back to the companies that they had been investing in and had been generating great results, the Magnificent Seven, but we kind of then spread out from there. So it's been really an interesting start kind of to the first half of this year. And you can see too, we're close now. The Magnificent Seven is kind of the outlier. They're down about 9.4% from its 52-week high. So going back a full year, they're off almost 10%, but everything else is extremely close as we finished out June to being just about at their highs over the past year.
This is a definite illustration of diversification. Yeah. If you were somebody who bought right in on those Magnificent Sevens, I'm going to ride this and ride this, this is where you got hit. Diversification is the key, and that's why we're a big fan of it.
That's right.
We don't want to not own it, but we don't want to only own it.
Yes, that's correct. That's correct.
Moving into the rotations, I believe.
Well, these are the sectors then too, kind of focusing, financials. I point them out. They had an excellent second quarter. Industrials as well. Real estate investment trusts. Technology still had a great second quarter, but it was really it was the breadth of technology. So again, getting away somewhat from those Magnificent Seven stocks, which are certainly still in the technology sector, but we kind of spread out to many other companies that are also generating the good earnings throughout the tech sector.
What always gets me is healthcare. That one bounces. It will be at the bottom, bounces back up. Bottom bounces back up. I find that interesting because of our aging population.
Yeah, it is.
And what technology is bringing to the healthcare field holy cow, this could be very exciting. And all of a sudden you're like, oh.
Yeah. Well, and you can see too, one of the areas that as people moved out of the first quarter, so the first 3 months of the year and into the second quarter, there was certainly a big change in healthcare. But a lot of that, I think, is beginning to reflect some of the stuff that I'm reading. I'm sure we're hearing about. What's starting to reflect is that artificial intelligence is operating and generating significant improvements.
Results, bringing costs down.
Yes, exactly, in the healthcare sector specifically. So
we could use that.
Yes, that seems to be one of the areas that's really picking up on that.
Yes. Yeah. You good?
So, yep, we can go to the next one here.
Thank you, sir.
Yes. So this is just our kind of our snapshot as to, again, it's more reflective of those of you out there, our clients, of the portfolios that you're going to own. Some of you are more aggressive, some of you are more conservative, so your percentages are going to change. But we point out all the time, Dan and I, we don't have any clients that are 100% in stocks. So with the first couple charts that we always look at, or that we've looked at here, the slides, those are really focused on the stock or the equity markets. This is a little bit more reflective of where your portfolios might fall. So starting at the top there, the 80% equities or stocks with only about a 20% allocation to bonds or fixed income. That's going to be your more aggressive investor, versus at the bottom of the chart there, only about a 20% allocation to stocks or equities and 80% to fixed income. That's the more conservative investor. Many of you probably fall somewhere in between there. But as you can see, the total return year to date. Now, we did fall back a little bit compared to where we had been the last couple months, and this is as of July 8th. When we ran these numbers. So there was a little bit of a fallback because the stocks especially had really rocketed up. So we saw some outsized gains in the portfolios that were a little heavier allocations to stocks. And we lost some of that during June, but again, we've also spread out a little bit more too. And we're still looking at a total return for 12 months. The fixed income has suffered, certainly, over the last, say, 6 months or so.
The seesaw.
Exactly, the bonds haven't performed quite as well as they had been performing. So you do see some slightly lower performance numbers when you look at the portfolios that are allocated more to fixed income.
I just want to make sure we understand about fixed income. To me, bonds are exciting.
They're interesting.
Everyone wants to talk stocks because we talk about those wherever we go, and one's up, one's down. But let me get to my point on the bonds. Even though the interest rate or the return may have fallen, remember when I talk to our clients, the coupon that bond is paying, the income that comes out of it, the heartbeat of that bond has not. So this is the example of we buy a bond and hang on to it as it goes up and down in value. But remember, that income that's coming out does not change.
Right.
So you might hold to maturity, collect all that income, even though you have the economic influences around the bond. And I do the seesaw because as interest rates go up, the price of the bond goes down. The price of the bond goes down, interest rates. And that's exactly what's been happening right now because of what's happening in the world.
Right. Yes. So that's a good point. And I mean, that's why a lot of people look towards fixed income or the bond investments as the foundation of a diversified portfolio. Right. Because of that steady income it does generate. So,
sir, may I move along, sir?
Yes, sir.
Thank you.
Yes.
Oh, where'd the green go?
Well, that's right. These are our speedometers, and those of you that tune in monthly, Dan and I always like to see as much green on the screen as we can possibly see. We've actually gotten away from the red, though, which is, I think, even in the geopolitical risk there down in the bottom right-hand corner, we've moved more into a neutral or a yellow color, according to Rockdale. I should point out this is their their speedometers that they point out every month. And this is our attempt to try to look a little bit down the road.
Right.
We're looking out the windshield here.
Next 6 to 9 months.
Yeah, exactly. And so we did have some more green arrows, it seems like, over the last couple months. We've ticked back maybe a little bit on a few things here, but the point is we're also moving, some things are moving in a very positive direction, getting rid of some of that red that's on there too. And yellow is not always bad.
No, we're holding steady.
Yes,
we're holding
exactly.
steady, and we're doing the right things. So let's just keep following the numbers and the indicators and head for higher ground. It's tough. I can't always see what's on the screen coming next, so I got to do the bend over and take a look at this. But I was looking at consumer spending up there. Consumer spending, on the second compared to consumer sentiment.
Yes.
And for many months, they were out of whack, and this is now the second month in a row that they've been right together finally, and they've been holding together. Yeah. You haven't seen the consumer spending decline, even though it's neutral. It's not declining.
Right.
And that's very important because the consumer is the largest driver of our economy.
That's exactly. I was going to say, as we point out all the time, I mean, what the consumer does drives, 70% of our economy.
So we got to make sure we're out spending and enjoying life.
That's right. So,
all right. So we got some robots running here. We got what do we got here? A
well,
marathon?
These are some charts, a couple charts. I sift through a bunch of stuff and try to identify some interesting things. And this is actually were some charts that were put out by Asset Mark, which many of you are familiar with. We do a lot of work with Asset Mark, and they have a great investment team there that we listen to quite a bit. But this is just kind of, they made it, I guess, the robots running at a track meet here with some corny acronyms, but it has something, it makes sense though. Policy and geopolitics are still driving the news cycle. They're certainly driving what people are how they feel about the overall country and everything. And AI spending continues. Those two things have not changed. I think the point that they were trying to show off here is that we've handed off the baton basically at the track meet, and they've now moved from what they referred to as pass, which included some monetary stimulus, but that's on hold really right now.
Interest rates aren't moving up or down.
Exactly.
Right? That's what that means.
Labor market and is holding steady. It's not necessarily getting any worse, not necessarily getting any better. It's just kind of holding steady, and inflation as well. It's sticky. It's sticking around, and we can't seem to defeat it entirely. But yet, it's also now, depending on what happens in the Middle East, if oil prices start to come down again, that will also have an impact on inflation. So, monetary stimulus, they've kind of moved that off the grid there, and they're looking at consumer resilience. And as Dan was just pointing out, the fact that the consumer is still spending and driving our economy forward, that's in return, then what that's doing is pushing earnings growth for our companies in our economy, and even economies across the world. The American consumer is still purchasing, and that drives the earnings of all of those companies. So kind of replacing some fiscal stimulus there.
And earnings will drive the stock price will drive the market. Now, what I want to be careful of is that we're not falling in saying, earnings are always good, earnings are always good. I want our clients to remember that the way we use third-party money managers, we're very nimble. We can make a turn very quickly. So if you see, you might be a belief that, the earnings look good and everything, but the other shoe is going to fall. Right now, we're going to run. We're going to run with this, and the earnings are good. But if the other shoe does fall, we are nimble enough to make a quick move.
It's a good word, nimble. Right. Yes.
And again, it's better than spry.
Yeah, well, that's true. But a couple more other charts here. These just kind of showing too. we do still have geopolitics as a whole is still messy in several areas of the world here. But what this chart, what they were attempting to show here, and I think it points things out very well. The geopolitical events don't necessarily derail the market. The market does respond. Certainly, it's part of the news cycle, and it affects sentiment a great deal. But yet the markets continue to plod forward. They continue to move on. And if everything else looks good, they're not going to necessarily get knocked off the track just by a geopolitical event or two.
That's exactly what I was saying before. Yeah.
So that's it. So that's kind of what they're trying to show here, that we've got some history to build off of. So this too is, one of the biggest factors driving the economy right now, obviously the consumer spending that we've been talking about, but also the spending on artificial intelligence and the build out of the infrastructure that's going to support the further development of artificial intelligence. And it's just, at this point, it's just projected to just continue. I mean, this chart goes up through 2031, and they're looking at, over about $7.5 trillion spent on this.
I can't get my mind around that.
Yeah, it's a huge number, and it's the thought is almost, what are they going to be spending those last couple trillions of dollars on? I mean, if we've already worked our way up to $3, $4, $5 trillion. What is that last couple trillion dollars going to be generating? But the talk is that there are so many different ways to spend, but to develop this computing. I mean, we've certainly heard about recently with Elon Musk, SpaceX, talking about creating data centers to do computing power in space. And that hasn't been proven yet. Well, but if Elon Musk is behind it, I mean,
everything starts with a dream.
Henry
Ford said, "Hey, let's build a car."
That's right.
This is such a time. This is a time in our lives that we're going to look back and go, "This was a big difference."
It's amazing.
This is the Industrial Revolution. This is big.
Well, and it's going to be interesting to see how it all does develop. And I think the concern that's driving a lot of this spending is companies don't believe they can be left behind.
Right.
They need to make the spending to keep up with their competitors. And that's one of the benefits of capitalism, or capitalistic society.
We're going to find out who's the smart spender and who's the stupid spender.
Exactly right.
And that's all going to be about watching the numbers.
Well, I like this chart too, because this to me is very interesting. Entrepreneurship is accelerating in AI intensive industries, and the amount of small companies
Spin-offs.
that are being started up. Yes, exactly. People that have their idea and they're able to get some financing. They go out there and they get started, and hopefully someday at least some of those are going to be developing the products we'll all be using here in another 5-10 years.
As I told you, my sister's in town this month, right?
Yes.
And we play a little game. What in our lives that we didn't have 15 years ago?
Oh.
It used to be when we got together to do this, the fax machine, the cell phone,
yeah.
right? We all reminisce about the phone on the wall and the hiding in the closet with the long
That's right.
cord that always gets
That's
tangled.
it.
Now, what's that going to be?
Yeah.
This is so exciting.
It
what
is.
are the kids going to be doing next?
I know. It's a
It
little
is
scary too.
Scary, but exciting.
I have a son that's heading off to college. In 4 years from now, he may be in a job, starting a job that doesn't even exist today. I don't know that there have been a lot of moments in the past when we could have said that.
Right.
And
I want to be involved in that. I don't know about you.
Yeah,
but
I do too.
I want to be involved in
and
that.
investing in it too.
That's what I mean, baby.
That's right. So, this just kind of shows AI investing is driving growth, capital spending. The companies investing in AI are growing faster. There's still a lot of debate at this point in time as to exactly how artificial intelligence is helping the companies that are investing in it actually increase their profits, overall profits, whether it's through a reduced workforce. We really haven't seen that yet. We haven't seen people being laid off and the excuse being given that they've been replaced with artificial intelligence. Instead, what seems to be happening is companies are retaining their employees and training them to use the artificial intelligence they've purchased to increase their productivity, something akin to when we all got desktop computers. Yeah, exactly. So that's an encouraging sign that companies that are investing in it are growing faster. One area of concern is that the hyperscalers, these are the companies that are really, that are driving this artificial intelligence build out. They are starting to tap into the debt markets quite a bit. So the first few years, they were able to pay for their artificial intelligence spending through cash flow. I mean, Google, Alphabet, the money was just rolling in, and they were able to divert some of that income to purchasing artificial intelligence.
Issue more stock without diluting the price.
Exactly.
Now it's getting to the point that they can't issue stock.
Yes, because the spending has gone so high. So it's not at an alarming rate or anything at this point in time compared to other industries, but it is a switch. So
And it's not uncommon either.
no, it's exactly. It's not necessarily an alarm. We're not ringing an alarm bell at this point, but what we are saying is that it is something to watch, that they're starting to tap the debt markets, issuing bonds, that kind of thing. So
This is why I said bonds are interesting.
yeah,
If you could
exactly.
see the bond that's issued on a specific company 6 months ago versus the bond that's issued currently, and you might see some might see some signs in there that, oh, maybe that's a little weaker than stronger.
Yeah.
That will be an interesting spot to look at. And you were showing earlier in a couple slides back about trillions of dollars being spent. Where's that money coming from? How many trillions do you have in your pocket?
Well,
I mean, how does that
Right.
spending happen? And some, we're very used to companies raising money through equity, through the
Yeah.
stock side. We haven't heard too many times companies raising a lot of money through debt.
Yeah.
And this is what's beginning to happen. Not uncommon, not an alarm sign, alarmed, or we're not calling holy cow
Yeah.
moment here. We're just noticing it. Now
Right.
let's see how this goes.
Yeah. So we got to play through that. So, and again, I mean, this talks a little bit more that it's not really, the global market is more than just the U.S. So this artificial intelligence, the spending is not benefiting just companies in the United States, international developed markets, those key markets, Japan, United Kingdom, France, Germany, but also emerging markets too. Now those would be considered Taiwan, South Korea, China, India, Brazil. So we're seeing that the earnings growth estimates by region are all increasing. So it's not just focused or limited to the United States. It's really a global phenomenon at this
globe's
point,
getting
which
on
is
board.
great. Yeah, exactly. So that's good. Yeah, and that, why this AI bull market is different, okay? Year-to-date return, earnings have driven equity return. So the earnings that these companies are reporting are driving the increased valuations of their stock. Year-to-date return, great. I mean, the S&P 500, year-to-date, I mean, we're halfway through the year and we're at 10% already.
With a lot of headwind.
Yes, exactly. Yeah, with the geopolitics and everything. So strong earnings, not higher valuations, have been the primary driver of market return. So again, we're not driving up valuations. Sometimes you'll hear reference to the dot-com boom back in the 90s. Those were valuations that just skyrocketed without much substance behind them. Whereas in this case, the company's valuations, of the stock valuations, are certainly increasing significantly, but they have strong earnings to back them up. So the consideration is that that's much more favorable than just,
when we saw
pie in
something
the
like
sky.
this last time, the
Yes.
dot-com, it was a fallacy or not a
Yeah.
fallacy. I'm sorry, that's
Well,
not the word,
it's,
but it was
it's
it disappeared quickly.
mirage.
A mirage.
Yes.
It's a mirage.
Yeah, any company would put .com after its name, and all of a sudden
go.
it would skyrocket in value, but without much substance. So
Now we got
yeah.
some meat on the bone here.
Yep, technology profits have kept pace with performance, so profits are increasing. So that's it. I just threw one last slide in here too because I thought, we're about close to the middle of July at this point, but not too far removed from July 4th, our 250th birthday here in the United States. And I do think, it's impressive where this country is in the world.
Yeah.
You look at this, these are current statistics, but we have about 4% of the world's, the global population. But we produce about 26% of the gross domestic product of the globe. We have 59 of the top 100 businesses, firms by market capitalization are located in our country. Notable AI models. We have about 51%. Certainly China has their models. There's other countries out there that are developing models. But we have the majority, slight majority of the models that are out there and are being developed, and our research and development expenditure. So this covers everything. I mean, it covers military research and development, but it also covers healthcare research and development and technology research and development. We spend about 27% of the global expenditures on research and development. So that's why a lot of the developments that really affect humankind, the globe, come out of this country, because we dedicate a lot of our treasure to pursuing those. So just thought that was kind of interesting.
It's a great way to talk about this at 250th birthday of America. And Jeff, thanks for pointing that out, because it's important to be proud of that.
Definitely.
But with that said, I want to thank everybody who picked up on my 2 throwouts to West Wing and Spry and Miraji to my Bugs Bunny days. But I want to remind everybody too, don't forget July 22nd, we have our Midsummer Economic and Market Review. If you'd like to join us, please text us, call the office, and get you on the list, and bring a friend, and that will involve we'll put some food on the table there.
That's right.
It's always a good time. So Jeff, thanks again for putting this together, and we hope everybody has a great summer. Take care.
Thank you.